Most traders believe success comes from mastering charts, patterns, and indicators. But the truth is, none of that matters if you can't control risk. Just one bad decision, one oversized trade, or one emotional reaction can erase months of progress in seconds. Because trading isn't only about finding good entries. It's about protecting what you've already earned. And without capital, you're out of the game. Hello traders, welcome back to the ComLucro channel. Today's chapter in technical analysis for day traders from basics to advanced focuses on the foundation of consistent results, money and risk management. If you can control risk, you can survive losses, stay in the game, and keep growing. We'll start by defining both concepts clearly, then bring them to life with real examples, stop placement, 2R targets, position sizing, and the math behind drawdowns and winning streaks. You'll also learn practical techniques like taking partials, moving to break even, and trailing stops, and how smart sizing connects directly to your psychology and execution. Because in trading, it's not just about making money, it's about keeping it. So if you like this kind of video, please like, subscribe, and turn on notifications. And join the ComLucro community to support the channel and keep improving as a trader. Now, let's start with the basics. What exactly do we mean by money and risk management? Risk management is all about recognizing and minimizing potential threats to your capital. Whereas money management is about wisely allocating and safeguarding that capital to maximize your profits. Both strategies work hand in hand to ensure one crucial outcome: long-term success in trading by preserving your capital and optimizing your profitability. Without a strong grip on these concepts, even the best trading strategies can lead to failure. Now, let's visualize a scenario where the market is trending upwards. We identify a strong level of support and notice a reversal candlestick pattern forming. In this case, we decide to enter a long position as the engulfing candlestick closes. To protect our trade, we place our stop loss just below the doji candle, aiming for a profit target that's double our risk. This approach ensures that even if the trade doesn't go as planned, our potential reward outweighs the risk we're taking. Let's assume we're working with a trading account of $1,000. The size of our position will dictate how much of our capital we stand to lose if the market hits our stop loss. For instance, if we decide to risk 5% of our account on this trade and the stop loss is triggered, we'll lose $50. Interestingly, even if we only win 1 out of every 3 trades, we'd still manage to break even. It might not sound ideal, but it's a strategy designed to keep you in the game longer, which is crucial in the volatile world of trading. But let's consider a tougher scenario. What if we experience 5 consecutive losses in a particularly challenging trading week? In that case, we'd end up losing 25% of our capital in just 1 week. And while that might sound extreme, it's more common than most traders think, especially for those who risk too much on each position. As Dr. David Paul often reminds traders, even a system with a 50% win rate can destroy an account if the position sizing is too aggressive. In his example, betting half of your capital on each trade would bankrupt you after just 4 trades, simply because of natural losing streaks. Even risking a third of your capital per trade would lead to total loss after only 8 trades. His point is clear. Most traders don't fail because their strategy doesn't work. They fail because they risk far too much on a single position. This serves as a powerful reminder that blowing an account doesn't necessarily mean losing every dollar. It can also mean suffering such deep losses that you're mentally exhausted and lose the confidence to make rational decisions. That's precisely where effective money management makes all the difference. By limiting your risk to just 2% of your account per trade, Even 5 consecutive losses would only reduce your capital by 10%, a setback that's manageable and recoverable with discipline and consistency. Later in this video, I'll introduce you to some powerful money management techniques designed to help you maximize your profits while keeping risks in check. But for now, let's continue to focus on the importance of risk management. So, how exactly does risk management play a role in the scenario we discussed earlier? Let's imagine that after entering the trade, the market starts moving against our prediction. The price breaks and closes to the downside, signaling that it might continue to drop and potentially hit our stop loss. Even though the stop hasn't been triggered yet, if we decide to close half of our position at this point, we can reduce our risk exposure by 25% on this particular trade. This proactive approach helps mitigate losses and preserves more of our capital for future opportunities. On the flip side, if the market moves in our favor, there's always the risk of a sudden reversal that could turn a profitable trade into a loss. That's why it's often wise to secure some of your profits before the price hits your final target. By locking in gains along the way, you reduce the emotional pressure and ensure that you're walking away with something positive, even if the market takes an unexpected turn. In essence, risk management is all about anticipating potential future scenarios and taking steps to minimize the impact of those risks on your trading account. It's about being prepared for the unexpected and having a plan in place to protect your hard-earned capital. Now that we've covered the basics of risk management, let's shift our focus to some fundamental rules, key concepts, and essential calculations involved in money and capital management. These principles are the backbone of a robust trading strategy, ensuring that you not only survive in the markets, but thrive. A critical question every trader must ask is, how much should you risk on each trade? The answer to this question largely depends on your personal risk tolerance. Essentially, how much money you're comfortable losing when those inevitable losing trades occur. There are 2 aspects to consider: risk tolerance per trade and overall risk tolerance relative to your total capital. Ask yourself, what percentage of my capital am I willing to put on the line for a single trade? And more importantly, would I be okay with losing this amount if the trade goes against me? Understanding and setting these limits is crucial for long-term success. Another key consideration is the psychological impact of consecutive losses. If you have a series of bad days and lose 5 trades in a row, how much of your account would you be down? And at what point would these losses begin to cloud your judgment and affect your future trading decisions? It's essential to know your emotional thresholds as well as your financial ones. Because even with a solid system, if you can't execute it under pressure, it won't matter. As Mark Douglas explains, consistent execution depends on your ability to trade from a calm, focused, and fearless mindset, one built on understanding probabilities. He emphasizes that every successful trader must first develop an edge, a strategy or method that gives a higher probability of one outcome over another. Once that edge is defined, the next step is to create a clear plan for how to use it, defining risk, position size, and profit objectives before ever entering a trade. But having an edge isn't enough. According to Douglas, true mastery comes when you can execute that edge without fear, when you can place trades confidently, knowing that any single outcome doesn't define your success. To reach that state, you must learn to think in probabilities, accepting both wins and losses as part of a larger, consistent process. With that mindset, you can design a money management plan that truly fits your risk tolerance. And more importantly, stick to it. Because when you risk more than you're emotionally comfortable losing, fear takes over, leading to impulsive decisions that can quickly damage your performance. For instance, let's say you decide to risk 3% of your account on each trade. If you encounter 5 losing trades in a row, your capital would be reduced by 15%. But you might wonder, why not risk even smaller percentages? The amount you risk per trade directly influences your potential gains. For example, if you have a smaller account and decide to risk just 1% per trade with a risk-to-reward ratio of 1-to-1, each winning trade would yield a 1% gain. However, if these modest returns don't meet your expectations, after all the effort you've put into trading, it's easy to become discouraged. This is why balancing risk and reward is so important. It's about finding that sweet spot where you're comfortable with the potential losses, but still motivated by the potential gains. Ultimately, your money management plan should be designed to keep you motivated. Your wins should encourage you to keep going, while your losses shouldn't discourage you to the point of giving up. If I were starting out with a small account, I'd likely risk around 2 to 3% of my capital on each trade. This approach offers a good balance, allowing you to grow your account steadily while minimizing the psychological impact of losses. So how exactly do we calculate the optimal position size when trading different currency pairs? Let's break down the process of calculating your position size when trading various currency pairs. This is a question I get asked frequently, and it's crucial to understand it so you can apply it effectively in your trading routine. By mastering this, you can ensure that each trade you make is proportionate to your account size and risk tolerance, giving you the best chance for consistent profitability. The first step is to determine how much you're willing to risk on each trade. This decision is vital for protecting your capital and making sure you can keep trading even if you hit a rough patch. For instance, if you have a $1,000 account and decide to risk 2% per trade, you're putting $20 on the line with each trade. This amount, your risk per trade, forms the foundation of your position sizing strategy. Next, you'll need to identify the stop-loss distance, which is the number of pips between your entry point and your stop-loss. The distance you choose will vary based on the currency pair you're trading and the specific strategy you're using. It's crucial to measure this distance accurately because it directly influences the size of your position. The larger the stop-loss distance, the smaller your position size should be, and vice versa. This ensures that your risk remains consistent across all your trades. That's why, before opening a position, it's crucial to analyze the historical volatility of the asset you're trading, especially relative to the time frame you're operating in. This step is often overlooked, but it's essential because a stop loss of 20 pips or a fixed financial stop defined by the trader might not be sufficient to position your stop loss at a technically sound level. In some markets or with certain brokers, it's possible to fraction your position to adjust your risk properly. For example, in the Forex market, you can often trade micro lots or mini lots to fine-tune your position size. However, this flexibility isn't available in all trading environments. For instance, some futures markets or broker platforms don't allow position fractioning, leaving you with the tough decision of whether to accept the higher risk or, preferably, to avoid the trade altogether. Remember, a trade not executed is infinitely better than a trade that results in a loss. When faced with such scenarios, it's often wiser to pass on the trade rather than compromise on your risk management principles. Now that we have the key components, your risk per trade and your stop-loss distance, let's bring everything together with a simple formula. This formula will allow you to calculate your position size accurately, ensuring that each trade is in line with your risk management plan. The formula is straightforward. Your position size is equal to the amount you're risking per trade divided by the stop-loss distance in pips and then multiplied by the pip value. This calculation helps you determine how many units of the currency pair you should trade to stay within your predetermined risk level. To put it simply, your position size is calculated by taking the amount you're willing to risk on that trade, dividing it by the number of pips between your entry and your stop loss, and then multiplying that result by the pip value. That final number tells you how many units or how much volume you should trade to stay within your risk limits. The pip value varies depending on the currency pair and the base currency of your trading account. For example, if you have a US dollar-based account and you're trading the euro against the US dollar, that's the euro-dollar pair. The pip value is usually around $10 for a standard lot. And that number is important because it directly affects how big your position should be and ultimately how much each price movement can impact your capital. By applying this method, you ensure that your risk remains consistent across all trades, regardless of which currency pair you're trading. This consistency is not just a good practice, it's essential for effective money and risk management. It helps you maintain control over your trading decisions and keeps your emotions in check, which are both crucial for long-term success. I hope this explanation gives you greater confidence in managing your trades. Remember, correctly calculating and managing your position size can make a significant difference in your long-term trading success. It's one of those foundational skills that, once mastered, will set you apart from less disciplined traders and put you on the path to consistent profitability. Up until now, we focused on money management concepts that prioritize survival and the preservation of your capital. But what about those times when you're on a winning streak and want to accelerate your account growth? How do you safely increase your exposure to capitalize on favorable market conditions without letting emotions cloud your judgment? One effective and safe method to grow your account faster, without letting emotions get the best of you, is to transfer some of your profits into a secondary account during periods of significant gains. In this secondary account, you can afford to take on higher risk than you normally would, testing how much you can grow it with more aggressive trades. The key here is that you're only risking profits, not your initial capital, which makes it easier to maintain emotional control and keep your primary account safe. Additionally, it's important to regularly withdraw a portion of your profits, say on a monthly basis, and use them to reward yourself. This practice not only reinforces your progress, but also keeps you motivated to continue in what is truly a marathon, not a sprint. If you try to grow your account exponentially without ever taking profits, you may find yourself burned out or stuck midway through your journey. If your goal is to generate consistent long-term income from the financial markets, then thorough preparation is non-negotiable. This means backtesting your trading setups at least 100 times across multiple currency pairs to establish an approximate win rate and gain confidence in your strategy. By doing this before you risk real money, you'll not only fine-tune your approach, but also build the discipline needed to stick to your trading plan and rules when the pressure is on. Having covered the essential concepts of money management, let's now turn our attention to some specific risk management techniques. We'll explore how to manage open positions effectively to maximize your profits while minimizing potential losses, ensuring that you make the most out of every trading opportunity. Let's begin with one of the most fundamental risk management techniques: how to bring your trades to a break-even point. This method is crucial for protecting your capital while still allowing your trades the chance to reach their full profit potential. Imagine the market is in a clear uptrend with a series of higher highs and higher lows. You decide to trade with the dominant trend, entering a long position. You place your stop loss just below the most recent swing low and set your target at a key level on the higher time frame, a level that could potentially mark a significant price reversal. This trade offers a favorable 1-to-5 risk-to-reward ratio, which is great. However, perhaps you've experienced the frustration of seeing your trade move into profit only for the market to reverse and hit your stop loss, turning a winning trade into a losing one. Or maybe you've closed your position early, securing a small profit, only to watch the market continue to your original target. These scenarios highlight the importance of managing your trade to avoid unnecessary losses and maximize your gains. To avoid these common pitfalls, traders often employ a simple but effective technique to bring their trade to a break-even point, which also helps to relieve some of the emotional pressure. Here's how it works. Once the price moves in your favor and reaches a level that is twice the distance of your stop loss, you close half of your position to lock in some profits. Alternatively, you could split your position into 2 trades, each with half the original risk, and set one of the targets at a 1-to-2 risk-to-reward ratio. This way, even if the price reverses and hits your stop loss after reaching your first target, you'll be at break-even and won't lose any money. After that, you can let the remaining position run, giving it the opportunity to reach your long-term target without the added pressure. You might also consider closing the trade early if you anticipate market volatility, such as during the release of high-impact news or at the end of the trading week. Now, let's move on to the second technique, which focuses on maximizing your profits by closely tracking the market's movements. This strategy involves trailing your stop loss as the trade moves in your favor, allowing you to capture trades with exceptionally high risk-to-reward ratios. As the price approaches a key level on the higher time frame in a bullish scenario, after entering a long position, you'll want to adjust your stop loss every time the market breaks the structure to the upside. Specifically, you would move your stop a few pips below the most recent swing low. By doing this, you allow your profits to run as long as the market continues in your favor. This way, your position can capture significant gains if the price reaches the higher time frame key level. If the market reverses before hitting your target, your trailing stop will help lock in profits, protecting you from losing the gains you've made. To bring this concept to life, let's take a look at a real example using an actual chart. Looking at this 5-minute chart of the euro-dollar pair, we can see that price has just touched a major structural level, one that could signal a possible turning point in the current downtrend. To confirm our entry, we identify a double bottom forming on the chart, a classic pattern that often indicates a potential reversal. Based on this setup, we enter a long position, place our stop loss just below the swing low, and set our target at the next significant level on the higher time frame, anticipating that the price will rally toward it. From here, we let the trade run its course. As the market continues to break to the upside, we'll consistently reposition our stop loss just below the most recent swing low. This approach allows us to track our profits effectively, giving us the opportunity to capture trades with substantial risk-to-reward ratios. At the same time, it protects us from giving back too much of our profits if the market starts to reverse. In conclusion, successful trading is not just about finding the right entries or exits. It's about mastering the art of risk management and understanding when to act and when to stay on the sidelines. By carefully analyzing the historical volatility of the assets you trade, properly calculating your position size, and adhering to your risk management rules, you set yourself up for long-term success. Remember, sometimes the best trade is the one you don't take. Preserving your capital and exercising disciplined decision-making are what keep you in the game long enough to seize the truly high-quality opportunities. And to truly master this way of thinking, where patience, discipline, and probability guide every decision, it's worth diving deeper into the psychological side of trading. We recommend our Trading Psychology course, especially the lessons Risk, Reward, and Thinking in Probabilities, Part 1 and Part 2. They'll help you strengthen your mental framework, refine your decision-making, and develop the mindset needed to trade with calm confidence and long-term consistency. Please also remember that our mission here on the ComLucro channel is to give traders the clarity and confidence they need to make smarter decisions in the market. Every video, every course, and every piece of content we create has one clear purpose: to deliver practical, easy-to-apply knowledge that helps you grow step by step as a trader. Here on the channel, you'll find complete courses on smart money concepts, technical analysis for day traders, and trading psychology. Because trading isn't just about charts, it's also about mindset, discipline, and risk management. We also share lessons and insights from some of the most respected names in trading, professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, Larry Williams, and many others whose experience has shaped the way we understand the markets today. If you enjoyed this video and found it helpful, please give it a like. It really helps more traders discover our content. And don't forget to subscribe and turn on notifications so you never miss our latest insights and strategies. If you'd like to go even deeper and access exclusive content, early video releases, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It's a simple way to support our work and a smart investment in your own growth as a trader. Thanks for watching, and I'll see you in the next video.